Michael, more investors are managing their own portfolios nowadays. So how does this impact the types of ETFs that are being launched?
Yeah, so the new ETF issuers are really listening to the retail public as to the things they want. It's very much driven by things like the FIRE movement or high income ETFs like Yield Max or Defiance. It's communities that are helping each other and essentially disintermediating the traditional financial advisor.
So what are these platforms offering, like Betterment or SoFi? What are they offering investors, and how does it differ from what traditional advisors have been offering and speaking to their clients?
Okay, so these new platforms like SoFi or Public or Blossom, which is like a social media version, they don't even offer mutual funds, right? So if you're not in the best wrapper, which is the ETF structure, you're not even going to be available. Betterment's a little bit different. They did do one mutual fund of their own, so they did set it up that way. But the retail crowd is really on Webull and Bullish and Moomoo and Public and all these fun places.
So if you are a traditional wealth manager, what are you doing to make sure the client gets what they want, gets what they need for their portfolios? You are seeing a lot of mutual fund companies turn their old mutual funds into new ETFs. So more along the lines of, what are wealth managers doing?
Yeah, so what wealth managers need to focus on today is either niches, like all dentists or all people going through a divorce, things like that, or tax planning, because the investment world has been democratized by the ETF wrapper. You can buy a single ticker ETF and have an asset allocation portfolio that's superior to 90% of the ones that a financial advisor would make for you.
So what are your expectations for the ETF industry heading into 2026? So for example, this year, we've had a whole lot of covered call ETFs. That's been very popular. What else are you expecting?
So we've had really good regulation in the ETF space, right? We had two rule changes, one exemptive relief, the other with derivatives. It's opened up the world to all kinds of structured products that have traditionally not been available to individuals. The covered call trade is a perfect example, right? Institutions have been doing that forever. Now it's available in a single wrapped ticker for individuals to invest in. So I think we'll see more and more of that. And the industry's had an amazing 2 years of growth. I mean, we tracked revenue for the overall industry. It's at over 20 billion for the first time as of this week.
And then finally, you have a tech ETF, and there's a lot of tech stocks, especially heavily weighted in the indexes right now. How do you avoid overlap?
That's a very good question. So I would like to say that ETFs are so transparent that people forget to look. For example, the Vanguard small cap ETF is 90% mid caps, right? So embrace the transparency of the product. Go and look and see what the holdings are. Make sure you're not paying 50 bips for what you can get for 5 bips.
All right. Well, thanks for coming on and talking about it.
Wonderful.